Yes, we have. Um, Coming out of the winter, which was our slow time, we were profitable for our first year, which was great. We had some cash in the bank and we could float ourselves. Through October, we were profitable every month. November was our first month that was not profitable, and December was again not profitable. And then we came out, and January, February were both not profitable, and March was just under profitability. So we had 5 months of losses. We carried cash through from our profitable first year to carry us for those first few months. When March and April came, the business began to ramp up very quickly. And the model that we use to ramp our business is to bring on contractors to help us supplement our team here when we exceed what we can do as a group. What that does is put you in a situation where you have to pay somebody for work that they've done that you might not necessarily have gotten the paid for yet. So coming out of the months where we had a loss, the cash reserves were used to float us during the loss, and when we grew, our costs grew, but the revenue that went with those costs was deferred by anywhere from 30 to 60 days, so we had an increase in costs without realizing that revenue at the exact same time. So coming out of a slow month into a number of growth months, we always were spending more cash than we were bringing in. So to address that, we did two things. One, we opened a line of credit with our bank. So we now have a line of credit that we can draw upon to cover cash flow issues. We will never draw upon that to cover losses, but we'll draw upon it to cover cash flow so that we don't get into a bad debt situation. The other thing we've done is we have injected some more personal cash as a loan, personal loan back to the company to cover those things. So we've opened a line of credit and we have personally loaned money to the company in situations when we know it's cash flow and we know that the money is tied up in our accounts receivable, it just hasn't come in yet.